The story of the hidden crash of 2026 does not begin in 2026, it begins decades earlier. In a financial system that has been stretching, bending, and twisting under pressures that most people never pay attention to. And the most dangerous part is that the cracks usually appear long before the collapse is visible. What we are seeing today is a sequence of events that look separate on the surface but are actually fused together underneath. Rising debt, shrinking purchasing power, exploding asset bubbles, geopolitical tension, and a complete breakdown in how money is supposed to work. If you zoom out far enough, the warning signs are impossible to ignore. And yet, for most people, the crash will look like it came out of nowhere. But that has always been the greatest wealth transfer in history. The moment when a crisis looks sudden even though it was quietly building for years. In this video, we are going to walk through how the crash is forming right now, why it will likely hit around 2026, and how it will create the largest wealth transfer of the century. Some will lose everything. But those who understand what is happening will be in a position to gain more than any ordinary market cycle could ever provide. Because every major collapse in history followed the same formula: the buildup, the trigger, the panic, and the transfer. So let us start at the beginning, with the buildup stage. For more than 15 years, the entire financial world has been fueled not by productivity, not by innovation, not by strong economic output, but by cheap money. After 2008, central banks realized they could rescue the economy by pushing interest rates to near zero and pumping trillions into the system. At first it looked like a miracle solution. But cheap money does not disappear. It floods into assets. Stocks, housing, crypto, bonds, everything began to inflate far faster than real wages, real production, or real economic strength. This created a distorted economy that looked healthy on the outside, but was fragile underneath. Then came 2020. With the pandemic, central banks printed even more, pushing global liquidity to levels no one had ever seen. That liquidity did not create a stronger economy. It created the illusion of one. But illusions always fade. And when inflation finally surged, central banks were forced to reverse course. For the first time in decades, interest rates shot up rapidly. This shift triggered the second stage of the buildup, the pressure phase. When rates rise quickly after a long era of cheap money, the system begins to break in unexpected places. At first, it was tech layoffs, then housing affordability collapsed. Then banks started showing cracks, and then entire countries began defaulting or approaching default. But the biggest pressure point is the one that most people do not look at: global debt. In the United States alone, total debt across households, corporations, and government has reached levels that are mathematically impossible to sustain with high interest rates. Every year the cost of servicing that debt rises, and those rising costs squeeze profit margins, government budgets, and consumer spending. That squeeze is what will trigger the crash. But the trigger itself is almost always simple. It can be a sudden spike in unemployment, a large bank failure, a major bond default, or a geopolitical escalation. The truth is, it does not matter what the trigger is. What matters is that the system is already stretched so tight that any shock can break it. And that shock will likely hit around 2026 because that is when three cycles collide at the same time. First is the debt refinancing cycle. Trillions of dollars in corporate debt must be refinanced between 2025 and 2027, but unlike the last decade, companies will not refinance at 2%. They will refinance at much higher rates. Many will not survive that transition. Second is the demographic consumption cycle. As the largest generation begins to retire, consumer spending declines sharply. Historically, this always reduces economic growth and increases market volatility. Third is the geopolitical disruption cycle. Supply chains are not stable. Global alliances are shifting. Energy markets are unstable. And every major international conflict throughout history has created a shock in financial markets. All three of these cycles colliding at the same time is extremely rare. And when they do collide, the outcome is almost always a wealth transfer. But the transfer does not happen during the crash. It happens before and after. Before the crash, money moves quietly. Institutions begin selling risky assets. Smart investors shift into defensive positions. Many begin accumulating cash, commodities, or undervalued sectors. Most people do not notice these moves. They are too focused on the dopamine of short-term gains or the hope that the market will continue rising forever. So by the time the crash becomes visible, the transfer has already started. And during the crash, the panic accelerates it. Ordinary people sell at the bottom. They panic out of stocks. They dump assets at huge losses. They cannot pay their mortgages. Their debts become unmanageable. Meanwhile, those who prepared correctly begin buying at discounts that only occur once every decade or two. But there is one more layer to the 2026 crash that almost no one is talking about. The crash will not just be about stock prices. It will be about purchasing power. Even if the market falls, the cost of living may not fall with it. In fact, many key costs may continue rising. This means wealth will not be measured only by how much money you have, but by how much your money can buy. And that is why this crash will be historic. Because it combines a market collapse with a currency decline and a debt explosion. This mixture is what creates extreme wealth transfers. During eras like this, those who understand what is happening and position themselves correctly do not just survive. They accelerate. They increase their buying power dramatically. They pick up assets when everyone else is forced to sell. They accumulate real wealth when the system resets. But the most important part is awareness. Most people will not prepare because they do not believe anything is wrong. They believe that the economy always recovers. That governments will fix everything. They believe that the economy always recovers. That governments will fix everything. That central banks will stop the crash. But history shows that once a system reaches this level of imbalance, it does not simply adjust. It resets. The question is who will be ready when it does. Because the crash of 2026 is not a single moment. It is a multi-year transition. And right now, whether you realize it or not, you are already inside the transfer window. You are standing in the early stage of one of the greatest financial shifts in modern history, and the decisions made during this period will determine where you stand on the other side. In the next part, we will go deeper into the indicators that confirm the 2026 timeline, the sectors that will collapse, first the assets that will survive, and the exact strategies used by investors who grow their wealth during crises instead of losing it. The warning signs for the 2026 crash are no longer theoretical. They are already visible in the data, the behavior of institutions, and the structural weaknesses forming beneath the surface of the global economy. What we are watching right now is the shift from the buildup phase to the fracture phase, the period where small breaks begin appearing across different sectors, each one subtle on its own but powerful when combined. And the first major fracture is in liquidity. Liquidity is the oxygen of global markets, and over the last 18 months, that oxygen has been disappearing far faster than most analysts expected. Central banks are not printing the way they used to. Commercial banks are lending less. Corporate borrowing is tightening, and every decrease in liquidity puts more pressure on the debt-loaded system. You can already see companies that relied on cheap debt struggling to refinance. Defaults on corporate bonds have climbed. Commercial real estate loans are failing. Regional banks are hiding unrealized losses behind accounting loopholes. And the most dangerous part is that the pain is not being evenly distributed. Specific sectors are absorbing the early hits, while others appear stable. This creates the illusion that the economy is still fine. But the cracks always hit the weakest links first, and then spread outward like fractures in glass. One of the clearest indicators that the fracture phase is underway is the behavior of bond markets. The spread between government bonds and corporate bonds has widened dramatically. Investors are demanding higher returns to take on even moderate levels of risk. This happens when confidence in the system begins to slip. Then there is the yield curve, which has been inverted longer than at any point in modern history. In every past cycle, an inversion of this length has always been followed by a recession or a crisis. But what makes this inversion more dangerous is the level of leverage tied to interest rates. Households are at record debt levels. Corporations are at record debt levels. Governments are at record debt levels. Debt is not just high. It is accelerating at the same time borrowing costs are rising. That combination is historically catastrophic. The second major fracture is in consumer resilience. Real wages have not kept up with inflation. Savings accumulated during the pandemic have been spent. Credit card debt is at the highest level ever recorded, and delinquency rates are rising faster than they did before the 2008 crash. Consumers are the foundation of every modern economy. When they weaken, the entire system weakens. And right now, consumers are holding the economy up not with strength, but with leverage. They are using debt to maintain their lifestyles, and debt-based consumption always breaks when income growth stagnates. Once households cut back spending, businesses lose revenue, layoffs begin, and unemployment rises. What most people do not realize is that unemployment does not trigger a crash. It amplifies one. The early stages of the crash begin before people lose their jobs. They begin when people lose confidence. Confidence is the hidden fuel of economic stability. When people believe the future will be stable, they spend, borrow, invest, and take risks. When confidence breaks, everything slows, and a slowdown in a heavily indebted system becomes dangerous very quickly. That brings us to the third fracture: government vulnerability. Governments around the world are spending more than they earn, and for years they could hide this through cheap borrowing. But in a high-rate environment, the cost of servicing government debt explodes. More tax revenue goes toward interest payments. Less goes toward public services, investment, and economic support. The United States, Europe, Japan, and several emerging markets are now trapped in the same cycle: rising interest costs, rising deficits, and declining fiscal strength. Governments will be forced to make hard choices. Either they cut spending and risk a deep recession, or they increase spending and risk inflation. But the most likely outcome is a chaotic mix of both, creating the worst possible environment for markets. The fourth fracture is forming in global trade. Supply chains are not stable. Shipping costs are rising again. Conflicts in key regions are disrupting the flow of energy, raw materials, and manufactured goods. Countries are shifting from globalization to protectionism. This increases costs, reduces efficiency, and weakens profitability across multiple industries. Technology, manufacturing, energy, and retail all depend on tightly optimized global supply chains. When those chains break, prices rise, margins shrink, and volatility increases. All of these fractures point toward the same conclusion: the system is approaching the trigger point. And while the exact trigger cannot be predicted, the likely candidates are becoming clearer. The first potential trigger is a major bank failure. Regional banks are already facing unrealized losses on commercial real estate, mortgage-backed securities, and long-duration government bonds. If one medium-sized bank collapses, confidence could evaporate instantly, triggering bank runs and liquidity freezes. The second potential trigger is a sovereign debt event. Countries like Italy, Japan, and several emerging markets are dangerously exposed. If any of them face a credit downgrade, a bond auction failure, or a currency crisis, the shock could spread globally within days. The third potential trigger is a corporate default chain. Companies with high leverage and low cash flow are already struggling. If a large company defaults, it could set off panic across the corporate bond market, making refinancing impossible for hundreds of firms. The fourth potential trigger is geopolitical escalation. A conflict in a major economic region can instantly tighten energy supplies, disrupt trade routes, and create inflationary shocks that force central banks into damaging policy decisions. Any one of these events can ignite the crash. But what matters more is how the system responds after the trigger. And based on how fragile the system is today, the response will likely be violent and fast. Markets will not fall slowly. They will drop sharply as liquidity vanishes and margin calls cascade through the system. Bond yields will surge. Currencies will fluctuate. Commodities will spike or crash depending on the nature of the shock. Retail investors will panic sell. Institutions will move quietly. The public will react emotionally. But through all of this, the wealth transfer continues. During the crash, assets that were overpriced become affordable. People who overleveraged lose their positions. Strong hands replace weak hands. It is not fair, but it is predictable. After the initial crash, the recovery phase begins. This is where the real wealth is built. Not during the panic, but after it, when assets are cheap, sentiment is low, and only disciplined investors are willing to re-enter. History shows that every crisis ends with a massive rally, but only those who positioned correctly benefit from it. In the final part, we will break down exactly how the transfer plays out. The sectors that will get wiped out first, the ones that will lead the recovery, the asset classes that survive a currency decline, and how ordinary people can position themselves before the window closes. The final stage of the 2026 wealth transfer is the repositioning phase, the period after the initial shock when the system begins to reorganize itself, and the gap between those who prepared and those who did not becomes permanently locked in. This is the moment where economic history is written, not by governments, not by central banks, and not by institutions but by individuals who understand the logic behind every crisis. At this point, the crash has already done the damage. Asset prices have fallen. Companies have failed. Banks have tightened lending. Consumers have pulled back. The media is panicking. Analysts are screaming about a lost decade. Politicians are blaming each other. But this chaos is exactly what creates the rare openings that only appear after a major reset. To understand this phase, you have to stop thinking like a consumer and start thinking like capital. Capital has no emotion. It does not panic. It simply moves toward opportunity and away from danger. So when the system resets, capital flows into assets that are undervalued relative to their long-term productivity. Historically, this has included specific categories of stocks, specific types of real estate, precious metals during currency weakness, and eventually, once inflation cools, long-duration bonds. But the timing matters. Entering too early is just as dangerous as entering too late. People who enter too early catch falling knives. People who enter too late chase inflated prices. So the first thing that must be understood about the repositioning phase is this. The bottom is not the moment of maximum fear. The bottom is the moment where forced selling runs out. Forced selling happens when institutions must sell because of margin calls, when households must sell to cover debts, and when companies must sell assets to survive. When forced selling dries up, the market cannot fall further without new catalysts. That is the beginning of the accumulation zone. During this zone, the smartest investors in history quietly build positions. They never announce it publicly. They never wait for confirmation from analysts. They observe behavioral shifts, liquidity flows, and structural signals that tell them the forced selling cycle is ending. And this is where the greatest profits are made, not by guessing the bottom perfectly, but by entering the zone where downside risk decreases and upside potential expands dramatically. Now let us break down the sectors that will likely be destroyed first during the 2026 crash, and the ones that will rise first after the reset. The first sector to collapse will be high-leverage companies in technology, real estate, and finance. Any business that relies on cheap debt, short-term refinancing, or inflated valuations will suffer the most damage. Highly speculative tech firms that grew based on low borrowing costs will see their business models tested. Commercial real estate, especially office space, will face a reckoning as remote work, debt maturity walls, and declining occupancy collide. Regional banks with exposure to commercial mortgages and long-duration assets will face liquidity stress. These sectors will not just decline. Many companies within them will vanish entirely. That is why smart capital avoids them during the early crash period. The second wave of damage will hit cyclical industries like retail, manufacturing, transportation, and hospitality. These sectors always weaken when consumers cut spending and when borrowing costs rise. Companies that rely on large inventories, high fixed costs, or thin margins will collapse quickly. But within these sectors, certain survivors will emerge with stronger balance sheets, leaner operations, and more pricing power. Those survivors often lead the recovery later. The third wave will hit emerging markets, especially those dependent on foreign capital or imported energy. When global liquidity dries up, capital retreats to safer regions. Emerging markets with high debt or weak currencies will experience deep drawdowns. This phase will trigger one of the largest global wealth transfers because assets in these regions will become historically undervalued, and institutions with long-time horizons will buy them at extreme discounts. But now we shift to the sectors that will rise earliest in the recovery. The first sector to rebound is always the one tied to fundamental human needs. Energy, food, basic manufacturing, and essential services remain in demand even during crashes. Companies in these categories with strong balance sheets often recover before the broader market. The second sector to rebound is technology, but not speculative technology. Instead, it is the companies that generate strong cash flow, provide critical infrastructure, and remain profitable even during downturns. These firms expand their dominance after weaker competitors collapse. The third sector to rebound is commodities and precious metals. When currencies weaken and governments face debt pressure, hard assets become a safe store of value. Gold typically rises early. Silver often follows. Industrial commodities recover later once manufacturing demand returns. The fourth sector to rebound is real estate, but not immediately. Real estate typically bottoms after the stock market bottoms because it reacts slower. However, once interest rates stabilize and distressed sellers clear out, real estate can become the most powerful wealth-building tool of the entire cycle, especially properties purchased during liquidation phases. So how does an ordinary person position themselves during this entire process? The first step is reducing exposure to fragile assets long before the crash hits. Fragile assets include high-leverage companies, speculative growth stocks, luxury real estate, and businesses that cannot survive high borrowing costs. The second step is increasing liquidity. Liquidity gives you optionality. Cash is not an investment, but during a crisis, it is ammunition. Those who have liquidity during crashes can buy assets that are unavailable during normal markets. The third step is protecting purchasing power. Inflation and currency decline can quietly destroy wealth even if markets fall. This is why a diversified mix of defensive assets like short-term bonds, certain commodities, and precious metals can stabilize a portfolio during the early phase of the crash. The fourth step is preparing a buying strategy before the crash, not after. Most people scramble too late. They try to figure out what to buy while panicking. Smart investors create a list of target assets, target prices, and entry ranges long before the crash begins. The fifth step is psychological preparation. Crashes are emotional. Watching your investments fall is difficult. Watching the news push fear nonstop is overwhelming. The people who survive financially are not the ones with the most intelligence. They are the ones with the strongest discipline. And once the crash begins, discipline becomes your greatest asset. During the crash itself, the strategy changes. This is the moment where patience and observation matter more than action. You do not buy aggressively while forced selling is accelerating. You watch liquidity conditions. You watch credit spreads. You watch insider buying. You watch institutional flows. You wait for the selling pressure to exhaust itself. Once the cracks stop widening, once the panic cools slightly, once the selling volume dries up, that is the signal that the repositioning phase is beginning. After that, the strategy shifts again. You begin accumulating high-quality assets slowly. You do not rush in. You do not chase volatility. You scale in over time, building positions during moments when the market is exhausted. And then, months or even a year later, the economy stabilizes. Inflation cools. Central banks loosen policy. Consumer confidence returns. Corporate earnings recover. Market sentiment shifts from fear to acceptance to hope. And this is where the wealth transfer completes. Those who panicked early own nothing but regret. Those who held through the crash recover slowly. But those who positioned correctly before, during, and after the crash emerge with more wealth than they had in the previous decade combined. Because this is how every major financial reset works. The buildup creates the opportunity. The crash exposes the weakness. The reset redistributes the wealth. And history shows that only a small percentage of people ever see the pattern clearly. The rest simply react to the headlines. But if you are watching this right now, you are not reacting. You are preparing. And preparation is the difference between watching a collapse and using it to transform your life. The crash of 2026 will not just be another dip. It will be a defining moment for an entire generation. And those who understand it today will own the future that emerges tomorrow.